particularly has accelerated the energy transition. And given the energy transition, how is the investment decision making, how that is changing, particularly in carbon intensive industries and also in allied electricity industries. And given that how the construct of the finance function in the organization has changed, there is a renewed emphasis on environmental, social, and governance factors. And given that what sort of measures are being taken in your respective organizations to tackle these emerging challenges and these emerging opportunities both. I think in every crisis, as I think it's a cliched saying that there is opportunity in every crisis. And I think the opportunity to quite an extent has been captured by India. Now, if we, for example, look at the electricity sector, the Prime Minister inaugurated the RE Invest yesterday, where he set a renewed goal of 450 gigawatt of solar energy in by 2030, which is quite a massive jump from where we are at about 40 to 45 gigawatt of capacity at this point of time. So that's the kind of renewable transition on the electricity sector that is being talked about. Then if you look at the oil and gas, there is a significant shift in this sector towards city gas. I think the gas-based economy is one of the stated objectives of the government. Now, I think that brings into point some of the legacy investments being made, particularly in carbon-oriented businesses. So oil and gas, oil potentially to some extent. When we think about mobility, the shape of mobility is likely to shift to e-mobility, which is electrical vehicles. We are already seeing changes, a migration to e-mobility on the city transport, urban transport. There is a little bit of action in terms of e-buses, etc. Metro is taking root in almost all the major cities. And then I think as the charging infrastructure develops, there is migration to e-mobility on the personal side as well. We are clearly seeing large-scale incentives and registration duty exemptions to mobilize more population towards e-mobility. Now, when we look at all of this, clearly, I think the investment landscape or investment decision making becomes really challenging. I think, and to top it all up, the pace of the technological change is massive. For example, earlier this week, solar bids in Rajasthan, which used to typically go at somewhere around 2.5 rupee a kilowatt hour, or maybe 2.4. I think they went as low as 2 rupee. And to spring quite a surprise, NTPC sprang a surprise bidding at 2.01. Interestingly, we acted as advisors to NTPC on their renewable strategy, but we never thought this 2.01 was feasible. So I think there is this wheels within wheels, and that is causing significant change to the market dynamics. I think we would really love to gather from you that as the heads of finance function who are responsible in a fiduciary responsibility to look at where the money goes, how do you think about decision making in these times, and what sort of goalposts do you keep in mind when it comes to deploying capital into new businesses? So, I think maybe Mr. Sugata, if you can start, and then I think we could pass the same to Mr. Subhash.
Well, okay. Yeah, I mean, all that you said is very relevant, and it's a very dynamic world right now. And understandably, what is happening is, especially in the conventional energy space, in oil and gas, because of the supply overhang, because of the pricing currently, because of the delay in the demand recovery because of the pandemic situation, etc. There is investors have become a little bit cool about this sector, and the valuations of energy companies have taken a very large beating, as you know. So even if you think about some of the global energy majors, like BP or Royal Dutch Shell or ExxonMobil, the depletion in market cap over the last 1 year is in the range of 45-46%. And even in India, a couple of companies have suffered that kind of depletion in market cap, and others are in the range of 25-26%. Now, I have a couple of kind of points, observations for deliberation. One is, now this is what is happening to the energy sector in terms of the energy companies' valuation. But if you look at a related segment in which we operate, we in Schneider Electric, we do products, solution services which are for distribution and management of energy, for energy efficiency and for automation. And other players in this field are ABB, Siemens, Rockwell Automation, Legrand, Honeywell, etc. So for the same period, for the last 1 year, if you see the Schneider Electric global market cap has improved by 40%, even in this market where the sales growth are actually negative. And we are not alone. ABB has improved about 24%. Rockwell has improved by 27%. Honeywell about 14-15%, and so on. So what is really happening here? Investors are looking at investing in businesses which will drive energy efficiency. Because the fact that energy will be consumed is given. So, because if energy demand and energy application does not go up, these businesses don't survive. So it's understood that the energy consumption and demand is going to increase, but the investment is going towards efficiency, automation, digitalization, etc. That is one perspective to keep in mind. The other thing is, if you look at the world energy outlook, the energy demand is going to increase, especially in India. You have significant, of course, there is very significant increase in renewables, but there is also increase in oil, gas, coal, etc. So even by 2030, if you see the basket which is being projected, coal and oil are significant, gas and renewables are also significant. 19 to 20% gas and renewables, about 30% coal and oil. So that being the case, these businesses will grow. Now that is given. So if these businesses will grow, and if there's so much interest in efficiency, automation, digitization, then I would say we to put these two together and think about how these our energy businesses can grow efficiently. And I can talk more about that later as what we are doing on efficiency, etc. But that is one theme which comes out, that how much can these businesses grow with efficiency, so that investments are made in the right place, your returns on capital are revived, etc. So let me pause here and listen to Mr. Subhash.
So I think, as Mr. Sarkar put it, we are in a state of transition. It goes without saying that we are in state of transition. And some of the things he mentioned actually had started much before the COVID came on the scene. As far as oil and gas companies are concerned, their valuations had started taking beating worldwide a little earlier than COVID. So it has been in the making. Probably we only missed the early signs. That is one. Second, I think what's very unique about these times, I mean, you can always say that we are in state of transition, lot of uncertainty. If you were to use this stanza, you could use it at any point in history, because world is always in state of transition. However, from an energy perspective, for a very major reason, actually a transition is happening, because historically there has been one or the other source which has been the dominant source of energy. So there was coal, it was followed up by oil, and there was some sort of a world order as far as energy sources are concerned. It was different at different places in the world, but overall there is a kind of balance. For the first time, we see it getting challenged, and now it is a matter of opinion as to which will be the dominant source of as an energy supplier, maybe in 2040, whether it is going to be renewables or it's going to be gas. And it appears today certain that coal and oil will lose their sheen. This is what is the present day thinking. Actually, I also don't think very differently, because I have no specific reason to think differently. But I do believe actually this world also assumes a lot of, it goes with a lot of assumptions. It assumes that coal and oil sector do not have capacity to rediscover themselves, or even gas if it comes to that. Is there a possibility, like Mr. Sarkar said, that technology can come where even the energy from coal or oil can be harnessed and extracted in a manner that it actually balances all the considerations, ESG considerations, it ticks in all the check boxes. It's today actually almost being believed that it is certain that these two dominant sources of energy will find it difficult to kind of adjust to that requirement, and consequently something else will need to replace them when it comes to meeting the global energy needs. Uh, Gas is a possible source, and there comes the issue of it actually being more justified in terms of being its capacity to balance, because renewables is perfectly fine. A lot is being said about renewables, and two, it comes as a surprise not only to you, to us also, because we also have aspiration to increase our footprint in renewables. And two, actually, is 244, 243 was kind of considered the benchmark, and probably one believed that floor had been reached, and two has actually challenged that, which gives rise to the fact that maybe even two is only a temporary figure for the time being. It's only a placeholder, and given 1 or 2 years down the line, there will be a new figure. So everything is in state of transition, and actually one can easily guess that it is very difficult to arrive at the right parameters on the basis of which decision can be taken today. It is the extreme, the entire industry is in state of transition. Notwithstanding that, actually certain fundamentals are there which will still regulate the way the energy industry takes off. For example, even if you look at the worst scenarios for oil and gas, there is quite likelihood that even 30 years down the line, number one, you will continue to use some oil in one way or the other. It could be petrochemical, it could be for as liquid fuel, or is for running the bit for mobility also. Now, actually, in the reservoirs, normal decline is of the order of around 8 to 10%. 10% could, if one were to take a figure of 10%, and if one were not to put in new investment, then within 5 years, actually the production will come back to around half. So having said that, investments are still required, notwithstanding the fact that you could require less of oil, or maybe even less of oil and less of gas. Gas is, I believe that gas is going to be not only a transition fuel, it's going to be a long bridge between renewables and coal. Renewables themselves, once they get more than 10% of a package, there will be huge issue of balancing and intermittency. Intermittency itself has a tremendous cost, and the systems, I believe, already in the places where it is 30 to 40% as far as renewables are concerned, the costs are becoming visible one way or the other. So I think under these circumstances, we have not moved much. Frankly speaking, right now we are recovering from what we have faced as COVID. We are trying to ascertain what is the right level of prices we can expect to prevail in future. I personally would believe that this 40, 45 is a price which necessarily needs to exist, even if one were to produce only that much, which is necessary to replace the depletion, normal depletion in the fields. And the world is getting ready to kind of produce only from those fields which are economically viable at that. As far as gas is concerned, it has a brighter future. Yet probably supernormal profit era is over, and lot of changes are happening in the entire value chain when it comes to gas also. So interesting pace, not that major investment decisions have not been taken in oil and gas sector during this period. It is only people are going through with the projects which were approved already. But definitely we are getting ready to look at the projects which we had shelved for the time being. So we would start looking at, and I believe that the current prices set a kind of price level at which we need to look at the viability of the projects.
Thank you, sir. That's thank you both. I think that's quite insightful. I think Mr. Subhash, you would recall we had the opportunity of working with ONGC on those small investments in startups. I think the startup program that you ran, where we made, I think ONGC made a couple of small investments in startups which were energy efficiency or technology underlying. So how do you both see that potentially as a business? I think given this uncertainty, would it be a right business strategy, even from an investment standpoint, to put eggs in multiple baskets and see that where exactly the pace of technology changes? So to take your example that you said that you also have renewable energy ambitions, for example. So is that an approach that both of you are looking at to stabilize your businesses or sort of wade them through this pace of change that we are experiencing?
So I think from our perspective, we are only trying to read the transition and kind of be on the right side of it before the world actually says goodbye, or actually becomes difficult to operate only in one segment. We would rather use the optionality to increase our footprint in renewables. Renewables from India perspective, actually any further investments in energy make a lot of sense. When ONGC will invest, it will not really invest globally in renewables. It will rather invest only to meet the domestic requirements. From Indian perspective, in fact, the further investments in oil and gas also are overwhelmingly justified, which may or may not be true of the rest of the world. Because if lesser quantity of oil was to be consumed, then obviously there may come a stage where the countries who are deficient in domestic supply, the producers in those countries will have certain strategic advantages. So from that perspective, I think what you said is startups is a smaller, creating certain options is a good way of looking at the situation today, and scaling up should some of those bets actually start paying dividend, or they mature as a possible scalable investment options. So startups continue. In fact, we do believe that there are certain disadvantages of being a large organization. In fact, if you are nimble and fleet-footed, it becomes easier. So startups help you to kind of reap the benefit of being smaller and smarter, and least turnaround time, and yet achieve the overall objective. So startups will remain. The only trouble for an organization like ONGC would be whether through startup you can expect a size and scale, because obviously whatever would come organically might not be justified, and if there were transition were to be really massive in this sector, then organically developed business perspective through startups may not justify the scale of investment for a company like ONGC.
All right.
Yeah, and I can add that for us as well, it's done at two levels. One is we work with startups at the local level, because we have a very large R&D facility out of India, which is for India as well as for the group. So there is a program that is run to see what is an offer from different startups and competitions and championships and all that kind of thing, to see what can be taken in as technology for different kinds of product development. And the group worldwide has a has a kind of an initiative to work with startups. But apart from that, there is investment in large application and software companies, because Schneider is progressively acquiring. For instance, this year also there have been two acquisitions. One which is RIB, the other is ETAP. So these are basically software applications which are used in designing buildings, and then building in the building phase and the operation maintenance phase, etc. So the augmentation of the products and solutions, for that investment and acquisition of software and application companies, that is happening as a group initiative. And working with startups is happening in certain hubs. We are one of the largest hubs for China. So in India, it's being done by our R&D facility. So to answer the question, it's clearly an area which is continuously being animated.
You're trying to create organization within organizations which are more nimble-footed. Great, thanks for that. Karan, I think it's over to you now. I think if we can just
Sure. No, thanks for that. I think that's a great start. And I think I'm going to pick on a few things that both of you said. So pardon me for that. But I think, and Mr. Kumar, this is from what you said earlier, that transition is a word that can be used in a lot of different contexts. And I think the other T word that one hears is transformation. And I think, again, from what both of you just said about, the advantages of being small and sort of nimble and, being more agile, I think in the context of the finance functions, we've been hearing that for a long time, that, finance needs to transform itself to be ready for what's called the future of finance. And at KPMG, again, we've had this initiative going where we're looking at how finance functions need to evolve. And I think I just want to pick your thoughts on a few themes that are emerging. And I think, as COVID has probably accelerated, this shift, like I said, and I think like you also said, this has been underway for some time now. But as the stewards of, the finance organization for your respective companies, I just wanted to get a sense from you that, if we look back at this last 1 year, I think a lot has just changed in terms of how, we continue to operate and service the needs of our organizations. Even from the discussion that we just had, in terms of where capital is, flowing in from, whether it's impact capital or social capital or more responsible capital, investors are also now starting to ask for, something beyond the finance. And by that, I mean, not necessarily the black bottom line that all of us have been accustomed to reporting and, from quarter on quarter, how much have our earnings increased, but really looking at a whole plethora of non-financial variables in terms of how to even measure an organization, how to value an organization, how to make the investment decision, and then how to measure the performance returns from that investment. And I think that is one dimension. And then I think interestingly, what has also happened with COVID is that the whole relevance of non-financial risks. When we look at our enterprise-wide risk management frameworks and just how resilient our organizations should be. I think if you rewind back until a few years ago, that basket used to be heavier towards the financial risk. But in the last few years, and again, I think this whole pandemic has accelerated this, the non-financial risks are front and center of really guiding the financial strategy for organizations. So I wanted to get your thoughts on both of these aspects. One that from a non-financial perspective, and it's interesting, we're all finance professionals here, but non-finance is certainly becoming front and center in terms of whether it's looking at how you create social value, whether it's how responsible you are for the environment, it's whether it's human capital and so on. So maybe just some thoughts from you on how both your organizations have been sort of dealing with this from a finance function perspective, and how do you see that evolving going forward, given where we are today?
I think you very rightly captured. Actually, today at a CF level, actually you spend far more time in areas which would not have been considered part of finance maybe 10 years back. In fact, all sections in a large organization like ours have specialists who handle those functions, and you can be pretty sure that with the kind of systems and controls you have in place and software support, the people end up doing a very great job. And I think as far as finance function or accounting function, compliance functions, they did pretty well during the pandemic also. But CFO's life was little more challenged because he actually takes these compliances, accounting part, audit part to be taken care of somebody. He has a general oversight of it, and there are specialist people who are taking care of it. He's responsible for it, yet it's not a thing which engages more than 25% of his time in any case. The biggest challenge immediately after COVID was to even look at collectively as an organization about the sustenance of organization. Now, when in March, look at the way how the clues can be, very strong clues can be missed. Pandemic might have started sometime last year. It was very much existing in March. And even an entity like OPEC on 6th or 7th of March, the way those negotiations went on, the world could not imagine the kind of risk the impending risk which was out there, and none of us was able to kind of decipher as to what we were likely to deal with. And within 15 days, everybody realized that this coronavirus is a very different kind of animal which you are dealing with, and you need to react differently. So CFO's job under these circumstances changed materially. Sustenance of the organization, sustenance of the operations, the welfare of the employees became a huge challenge. And in our case, let me also share some personal experiences within ONGC. What happened was our offshore installations and quite a few of onshore installations are manned by people who operate from anywhere in the country on a 14 days on-off pattern. And all of a sudden, all flights stopped operating. So the health, welfare, well-being of these people who were stuck and their families became a huge issue. There were additional problems which our technical colleagues were facing because of the disruption of supply chain, domestic as well as international. Some of the things you had anticipated to receive during this period were not likely to come. So they had their own, alternative scenario planning to be put in place. So they had to get involved in transactional things, while in routine matters, somebody else would have taken care of that. So under those circumstances, actually, it was quite a challenge for me to take up the responsibility of steering and leading the operation of our entire crew change. And let me tell you, till end of May, we ended up, flying in and out around 4,500 people when no flight was operating. And with the kind of, obviously, the people on the ground did it. But I can say with pride that as an organization, actually, it was also an opportunity to look at and assess the capabilities of organization, inherent capacities. Not even a single case, actually, we had a trouble. Anybody we picked up from his home was, taken to the installation, and anybody who was taken from installation was taken to his house without disruption. And that disruption, there was only one isolated case where a person was stopped at 2:30 at night by somebody because he did not have the valid documents around Agra, and he had within even 1.5 hours that person adequate documentation and support was extended, and the person reached home. So that's one thing I'm saying, that there is no compartmentalized division of roles and responsibility when it comes to the leadership position. That is one. Second is, even prior to this, we were in midst of completing our risk assignment with KPMG, and they were one of the they are the one who are helping us in kind of preparing and relooking at it. Now, nobody had envisioned anything like COVID. So even after having completed the exercise, we were in for a challenge that we had to rewrite quite a bit of it and see if we were actually prepared. If had we actually finalized that manual or set of practices, would they have sustained? And it actually is a kind of testimony to the kind of teamwork between KPMG and us, that our team, that actually it ended up addressing quite a bit of issues. So today, actually, CFO job, while he is responsible for certain X, Y, Z areas, actually goes much beyond that. There is no way that he can aspire to be successful without looking at the entire organization. It's not a subset. It's something else. So if somebody is looking at technical versus somebody is looking at HR, again, it is not very strictly restricted to the specific domains. It is organization wide, but still one can aspire to be, let's say, even successful by concentrating only on his function, but just by doing accounting, compliances, and ensuring the audit and submissions in a timely manner, CFO cannot be successful. The role actually starts from there. So this is the base 25%. 75% is what is rated on, and which is not really specified, which is not really defined anywhere.
Yeah. So,
Yeah,
before you
I would
chime
agree.
in, if I can just maybe also ask you to reflect on what Mr. Kumar said, but also in terms of the
Yeah.
ability to have built resilience through this period, and I think that was one key message I took from Mr. Kumar's comments. The fact that we've had to all deal with this has kind of stress tested all our business continuity, risk management frameworks. But what does this do for us going forward? I guess maybe if you can also think about, reflect on that for us. That as an organization now, do you think you're better prepared because of having gone through this crisis? And the fact that you have a business environment that's very rapidly changing towards the focus is shifting from, let's say, heavier carbon to a lighter carbon, and net zero in fact is also being talked about more and more often now. So over to you, Sagar.
Yeah. So let me start with transformation, because while we are running a large finance transformation journey, but before that, over the last 1 year, I was leading the revamp of our entire marketing organization across our businesses in India. And that I started doing because it is related to business value creation, it is related to efficiency, etc. To kind of echo what Mr. Subhash was saying. So this is a role which obviously it involved working with a number of people, and then we finished it with a new mutualized marketing organization. I'm currently, and this started about 3 months back, sponsoring sales process revamp initiative, which is basically to change the mindset of our sales force to use more and more our digital assets like collaboration tools, like virtual demonstration tools, etc., to get in more efficiency and so on. So the interesting thing, again, I mean, this marketing reorg thing started before the pandemic, but what the pandemic did for us is that we could bring it to an acceleration and completion quite fast, because we were in a situation. And the sales process reorg also started when we started seeing how much we are saving on travel costs, for instance, to start with, and how much the customers have become acceptable to doing remote engagements. So these are opportunities which were grasped, and so I'm leading it as one of the leadership team in the zone, and there are others leading other things. So the CFO's role is kind of transforming in that way. As far as finance transformation is concerned, so we are running a major thing where we're looking at several angles. One is, what should finance do? For instance, when you think about, and we call our finance CFOs who are attached to businesses, we call them finance business partners, and then we support them with financial planning, analysis, etc. So what should FBPs actually give to the businesses? And what is coming out is a major area is forecasting. And it's actually laid open our inadequacy of forecasting tools in this pandemic, because I mean, how do you forecast this kind of thing? Of course, no one can forecast, but you also realize that the traditional ways of forecasting that we tend to use are not adequate. And you can use machine learning going forward. Not that we have adopted it fully, but this is something that we're thinking very, very strongly about. So we are kind of rehashing what finance should do. And one thing which is coming out is the skills to analyze data, put it together, find a business meaning of it, and give insights to business proactively. Not to keep doing scenarios what the business is asking, but to give analysis proactively so that there is action in the business. So this is one area of big thought which is happening, and we are remodeling the finance function that way. And the other big area is data.
I'm sorry, I'm going to interject you there, and the reason I'm smiling is because if you look at my notes, I had the word business partner and I had forecasting, as the top two bullets, and you just covered them. But I just want to take you back to that because again, we've all been talking about the fact that we need to move away from the historical sort of accounting, reporting focus to being true business partners, and to add to that the challenge of now having to focus in this world, right? I mean, I remember a few years ago I was talking to the CFO of a global organization that do you 2-3 year forecast? And he actually laughed at me because he said, I don't think 3 years is a range anymore. Yeah? The planning horizon can't be 3 years because I can't even think beyond a few months now. And this was a few years ago. Now if I fast forward to today, beyond where we are, all have gone through. What is the planning horizon anymore, right? And so I just want to take you back to that point before you move on from that thought. That how are you dealing with that? The whole the uncertainty that's been thrust upon us now. And while again, one can look at more advanced techniques, like you said, just to, maybe give me some real sort of lessons that you are implementing.
So we're doing quarterly reforecasting, Karan. So if that is near enough for you. So we are doing quarterly reforecasting because the whole messaging that we are giving into the organization is agility is okay. See, earlier was you got a budget, you got to stick to it, because if you don't stick to it, then you don't get your incentive, etc. So now what we are saying is quarterly forecasting, read the signs quickly, and if you say that this is not going to happen, and I'm saying revenue, then what can we do about it? We are welcoming such feedback and not beating the guys who are bringing that feedback. So that's the change. So we are encouraging agility, because then we can think about what can we do about it. And so especially for this year, while we have not changed our original targets, we are changing the parameters by which we will be measuring performance this year. And this, I think, is going to stay. It's going to kind of evolve even going forward. That how can we build in agility in measuring people? We do have a long-term plan, and I've been in the gas industry, and Mr. Subhash, I'm sure, we used to have a 20-year plan and then a 10-year plan and so on. So, which, gas industry, because you invest so heavily, you have to make those plans. But now you have to have this agility. So that is one change that we see, and the acceptance of the fact that environment is changing. So some things are going to be different. So let's brainstorm what can we do about it. So that's on the forecasting, which is changing, to answer you.
Excellent.
So I think as far as we are concerned, actually, see, we immediately after pandemic, as you are very right, something which we thought we'll be doing by 2040, we have slightly put all those things aside, and we have started kind of looking at things as to what puts us back on the course in a year or so. So, but luckily for us, actually, we could see that a large part of operation is in offshore. So once you are able to take people to the installations, actually operations can be run effectively without much of the trouble. As far as the things like, some of other activities in the field onshore are concerned, those are more difficult, in fact. So we started looking at more in terms of probabilistic analysis of going ahead with certain level of activities, and that has actually served the purpose. We believe that we have fairly good handle on what we are likely to do now, because by now we know for certain we have contingency plans in place, and from next year onwards we will be in a position to start ramping up, and again on course to achieving the bigger targets. But I'm very sure that whatever we had anticipated to do by year 2030 or 2040, we will take a very hard look at whether those targets still stay, or whether those are even worth pursuing or not, or they need to be rewritten. So that's going to happen, because quite a few things we noticed. One is transition towards renewables. Whether it is what shape it will take, people can have different views about that, but it's a very, very relevant consideration as far as energy industry is concerned. Second kind of let's say point which came to the fore was that the manning of the different tasks. We realized that you could in fact do with quite less number of people than what you have in offices. So today, practically, I think it should be possible, except for the operations which need to be manned by exactly the same number of people. It can't be materially reduced. But when it comes to the services and support functions, one could possibly do with the significantly lesser number of people. And one can actually organize these functions far more effectively if you were running them as kind of shared resource center from one or two locations, and two locations because you don't want to be disrupted again if something was to happen in some single place. So these are 3-4 learnings which we have captured, and we believe that that will have a lasting impact on the organization. We will sure benefit from it, and we are there. Probably worst is over as far as oil and gas, and especially for India is concerned, and we are almost getting to benefit from the upsides whatever happen in oil and gas space. I may also tell you that I have another meeting, so I may have to jump off this meeting in another 2-3 minutes. So if there is any quick one you can ask, otherwise I'll
certainly
to kind of.
Certainly, I'll be quick about this. I think you can't have a conversation these days without talking about ESG, and I think I'm going to close it off with talking about ESG. I think, and while Hitesh mentioned in his opening remarks, I just want to take this back to you now. I think there's no boardroom conversation that's not discussing ESG today. It's become front and center in terms of how organizations are both raising capital, deploying capital, and how is it measured. I just wanted your thoughts, both of your thoughts on, is it a fad or a phenomena? I think, and then maybe how are your organization sort of dealing with it?
Because of the time constraint, if you can allow me to be the first one, I believe this is a very relevant consideration. Yet, maybe it may be overhyped as of now. At the end of the day, see, organizations themselves do, and businesses change over a period of time. There is no way a business can continue and has ever continued without respecting whatever is happening in the society at large. So in society, if the demands, if the expectations are changing, all businesses have changed. They have to change. There is no escape. But to also expect that next day actually everything will change, that's not going to happen. From ESG, from investing perspective, I do believe an interesting change could happen. That like you have two kind of investments in businesses, one from equity and maybe from debt. Maybe even equity could be sourced from two sources. One is the investor expecting the financial return, and another could be the people expecting the social returns from the businesses. And if two come up together, then that could end up being a good model that could evolve. I believe that, and eventually the trade-off could be, or the performance could be shared in a manner. If the project is under delivering on social consideration, ESG considerations, then maybe there is some sort of penalty for the people who have invested from purely economic consideration perspective. So this kind of model could take off, where ESG and non-ESG could participate and help the businesses grow. But the tendency will be that ESG will be a relevant consideration from all perspectives. But it is not going to be the only one. At the end of the day, if business is done in a responsible manner, but it starts losing, that's a height of irresponsibility. That's also not a good combination. So with that, I'll take leave.
Quite interesting. Thank you.
Thank you. Thank you. For sharing this platform with you. Thank you.
Thank you.
Thank you.
Thank you very much. Bye. I'll take leave. Thank you.
Sure. Mata, over to you for your thoughts on ESG.
Yeah, so I'll finish on that one. So see, ESG is a part of our organization because we are an energy management efficiency company. So sustainability is a very core part of energy. And the group has signed on to the United Nations Charter on the 17 goals. And there are various ways in which it is ingrained in the business. One is it's ingrained in the products because we are developing products which are green. In certain cases, in breakers, greenhouse gases are being replaced with air. I mean, this is one which is currently just launched, where greenhouse gases has been replaced by air in a new design of a breaker. So products are being designed with sustainability in mind. For the organization, there's a huge drive. We have a green strategy, a green supply chain strategy. We want to be carbon neutral by 2025, net zero emission CO2 by 2030, and there are structured plans towards achieving it. It is measured by business, by territory every year. So it is very, very ingrained. It's a part of what we do. And if you listen to our global CEO also, it's very much a part of what we believe we are as a company. We're an energy efficiency kind of company. So it's very much there, very much ingrained. And if I step back and think about it as just a professional or as from the investor climate, I see tremendous appreciation and awareness among investors for companies who respect ESG. It has been well understood, I think, that ESG is good business, and sustainability in the English sense of the term. If you have to be sustainable, this has to be embraced. So I think we've come a long way from the time that if you only implement it in a way that if you don't do it, you're penalized. I think we are far away from that.
I think that's fair, and I think even to echo what Mr. Kumar was saying, in fact, we've all seen how social capital and impact capital, even in terms of dollars raised, is really ramped up. I think COVID's been a good kicker in that sense, and in terms of bringing this back up, front and center. I think we've kind of run out of time now, but I think this has been a really good discussion. Thanks for your time, Sugata, and I think the themes I've picked up are really the fact that transition is perpetual in a lot of ways. So is transformation, and the more nimble you are, the more resilient you are. But I'm curious to know what Hitesh thinks.
Well, absolutely. I think the last thing I would want to really say is that, which is a bit controversial, but there is no capital which is not socially responsible now. I think if you look at most of the large pools of capital, I think they have moved away from carbon businesses. So to my mind, I think energy transition, of course, as all the panel acknowledged, it's there and for perpetuity. But I think the fact that the capital will become socially responsible, I think that is imminent and it's already taking place in front of us. I think with that, I would also thank Mr. Sugata, and with this, we can close the panel.
Thank you very much. Pleasure.
Thank you.
Thanks a lot.
Thank you.
Those were some great conversations earlier in the day today.